Well, here we go again. September living up to its reputation as one of the rockiest months on Wall Street. The market closed lower on September 2nd. The tech sector has been taking it on the chin all week, and everyone's asking, is this the beginning of something bigger or just market drama as usual? I'm Tara McBride, Chief Marketing Officer with Prime Capital Financial, and per usual, I've got my friends Will McGuff, Deputy Chief Investment Officer, and Clayton Allison, Portfolio Manager, here to help us sort the headlines from the noise. So let's get into it. Clayton, tech has been leading the charge for so long, and now it's leading the sell-off. What's behind this sudden swing?
Yeah, I think you could probably point to last week's NVIDIA earnings. Now, NVIDIA has obviously been the market darling for the last 2 years as the whole new AI secular tailwind has really taken hold of everything, and they're obviously the poster child of that. Now, their report was still very strong. They posted, record numbers and things of that nature, and still gave a relatively strong guide. I mean, you can't really poo-poo any guide that's still projecting $50 billion worth of revenue. But it wasn't quite as high as the market was hoping to hear. They were expecting, stratospheric guidance and raises and things of that nature. On top of that, you're starting to see export controls and reductions of sales being able to go to China via geopolitics. So obviously, NVIDIA kind of sold off a little bit. And lately, you've kind of had the entire tech sector really stretched on valuations. Everything looks kind of frothy and expensive across the entire sector. So all you kind of need is that little tipping point of where you're like, maybe everybody's not going to be spending so much on AI as we thought, to then have some people start re-rating back down, maybe taking some profits in that nature. Now, the fundamentals of these companies haven't really changed. It's all just a question of, hey, is the spending kind of paradigm starting to slow down a little bit? So when NVIDIA, which had grown to be the largest company in the S&P 500, sells off, you're going to kind of see everything that's attached to it also sell off as well, which is what we're seeing over the last week.
Yeah, you used my favorite word, frothy. But it's great to hear that the fundamentals haven't really changed. It's just maybe the market's taking a little bit of a breather and kind of rebalancing, right, recorrecting based on the frothiness. So we've got the Fed hinting at rate cuts and a jobs report looming, two huge market movers. Both of you, Will, Clayton, weigh in here. How should investors be thinking about these catalysts when the market's already jittery? Will, why don't you kick us off?
Right. And so I love the phrase you just said. The market's going to rebalance for you if you don't rebalance yourself. So be very cognizant of your exposures. And right now, you nailed it perfectly. The Fed is driving everything with rates. And so they're focused on inflation and the jobs market. And so we'll know a little bit more towards the end of this week with August's numbers come out. We have seen revisions downward in prior numbers, which isn't the best thing that's out there. And we also have an administration that's really pushing for lower federal funds rates so that the interest expense of our nation's debt can start to be a less percentage of the overall budget as they're trying to work on the deficit. So again, we just talked micro with tech and NVIDIA. Here we're talking macro, and it's just the constant wall of worry that the markets have, and working with the financial advisor to make sure that you have the right amount of risk in your portfolio is ultimately paramount now more than ever.
Yeah, and it's like, Clayton, is this like a don't look at your 401k statement week, or is there some sort of opportunity hidden in here?
I mean, for the vast majority of people, I wouldn't be looking at my 401k for vast majorities of the time. Like, that's exactly what it's for. It's long term, and to Will's point, as long as you're making sure, you should really only be checking that 401k to make sure that you're really in your specific risk profile that you're comfortable with. Even if it's not your 401k or if it's just a brokerage account or anything of that nature, yeah, you can check it, but I would not be using macroeconomic data points as trading signals for, especially if you're a long-term investor, which is everything that we preach. These are very short-term signals. They could lead to longer-term shifts in the economy, but in the end, your plan should be 10, 15, 20 years out, not the next 6 months, which is really what's going to be kind of shifting markets over this near term. So to your point, Tara, no, don't look at your 401k. Just make sure it's properly allocated, like Will mentioned, with your financial advisor. But otherwise, set it, forget it.
Yeah. All right. Well, September is actually a historically bumpy month. Is that where is what we're seeing now just seasonal turbulence, or is there something different going on this time?
Yeah, I would say that the seasonal aspect of the markets is actually something to pay attention for. If you think about just general psychology, most investors and everybody hopefully has been enjoying the summer. So they've been taking vacations, hopefully not looking to your accounts every day. And so the industry kind of comes back to work after Labor Day, which is where we're at right now. So I do think there is some seasonality at play here. We also have to put in context where we are. We had 20% plus years in 2023, 2024, and we're 10% plus ish this year. I know it's kind of bouncing around that level right now with regards to the SPX. So we've had a really good 2.5 years. So a pause, a little bit of a pullback isn't necessarily the worst thing in the grand scheme of things here.
Yeah. So there's some turbulence, but it's not necessarily time to pull the chute, right?
Unfortunately, nobody has a crystal ball, so.
Yeah. Fair point. All right. Always keeping me honest, Will. I appreciate it. So, yes, headlines are loud, tech is wobbling, politics are messy, but as always, the market is bigger than 1 week's drama. Thank you, Will and Clayton, for reminding us that turbulence doesn't mean we need to deploy our ejection seat just yet. And always, we want to have a little something for you to take away from this conversation, dear audience members. So scan the QR code on your screen to download our paper on tax strategies for high income earners. It's a great starter kit for discussions with your advisor about how to keep more of what you earn. So thank you for joining us today. And don't forget to stay informed, stay invested, and as always, we'll be here to help you navigate the twists and turns of the market. Until next time.